bonds and stocks kind of go skipping off down the road, holding hands. Stocks might run faster to get to go up or down, but bonds are usually going right there with them. Maybe we need to be a little more nimble and a little more open-minded in how we're allocating client monies for, tomorrow, not just for yesterday. You're listening to Successfully Retired with Hamilton Brandenburg. Okay, I am joined today by a really fun guest. Austin, you probably don't get called a really fun guest all the time. Austin Preece of Preece Financial Planning, the financial planner, real estate specialist, and accountant extraordinaire from the great state of Wisconsin. So,
extraordinaire.
Austin, welcome to the show. It's fun to have you on, and we're going to crack into a topic today that I know you and I have kind of done a little bit of offline chat around that is, I don't know, I think it'll be interesting.
Yeah, I think it will be too. I'm excited.
Yeah, so today we're kind of talking about crypto. I don't even know if we have a title for this episode, but it's like, I don't know, I guess you could say crypto, is it a scam or is it for serious investors now?
Sure.
And maybe this is the sign that crypto is peaking when retirement planning financial advisors are talking about it on their podcast. It's like, okay, we're peaking, time to get out. But no, you and I had a cool conversation a couple weeks ago. You actually did a LinkedIn post. I don't remember if you remember this, but you're like, if your financial advisor just dismisses crypto completely out of hand, he either hasn't done a lot of research or you need to find a new financial advisor.
Yeah.
Do you remember that?
Yeah, I didn't realize it came off quite that strong,
It didn't. I'm putting my own spin on it. It did not come off that strong. I want to hear, like, from a rational, no offense, crypto bros, rational, intelligent investor who's also a fiduciary to his clients and has to legally act in their best interests. Like, let's start talking about it. You and I both listened to a podcast episode and read Rick Edelman's white paper. So I guess the question for you is, we know that crypto bros have been kind of talking about Bitcoin and all that stuff for a while now, but why are people who are kind of in more traditional financial roles starting to talk about it more? What is the leading cause of, like, why the hype around crypto? Why the interest at all to begin with?
Yeah. I mean, I would point to two or three main things that have happened over the course of the past couple of years. We finally got a spot Bitcoin ETF and a spot Ethereum ETF. So for those who maybe don't know what that means, spot is just a fancy finance terminology for buying it at the price it is at right now. We had access to, like, futures-based, derivative-based Bitcoin ETFs, which just they don't give you as clear of access, right? So having a spot Bitcoin ETF was really a big catalyst, I think, for people in our shoes, because now it's really easy for me to buy an ETF that gets you direct access right within a Roth IRA, so it's a lot easier for us to allocate to it. And it's more like buying a stock than it is buying a currency, right? So I think that is one big thing. The other big thing is the election in 2024. The Trump administration has been very pro crypto. So seeing that happen, Bitcoin went up quite a bit right after the election, kind of had some downside shortly thereafter, but then it's kind of recovered the past few months here. So those are the two, I think, main things that have made it a really, more in the mainstream recently. Would be my take. What are your thoughts?
Because beforehand, if you wanted to own crypto, it was like, well, let me go find somewhere that has a digital online wallet and buy it there. And then you get into questions of, like, whoa, do I need to worry about the taxes if I sell this thing?
Yeah.
And for a lot of investors, it became, if they were doing it on the side, it created more hassle where you couldn't just go open a brokerage account at, say, Fidelity or Schwab or something and purchase a lot of investors have their S&P 500 ETFs or whatever else, and now they can do that with their crypto as well. I guess so availability has definitely opened up. We've got a more pro crypto administration, but like, why the need for it? Why do you think that people are feeling like they need access to a crypto market?
Yeah. So I think we should talk a little bit about Rick Edelman's white paper that you mentioned. It's called
Yeah,
The
I'm
Death
teeing you up
of
for that for sure.
Yeah, the death of 60/40 and why your crypto allocation should be 10 to 40% of your portfolio. And that, that's a little
Rick
aggressive
really
for
just
me.
likes to just barely dip his toes in the
Oh my
water with
God.
his opinions there. Not a very
Right?
strong opinion at all.
I think he calls it the correct crypto allocation, which is just
Yeah.
so arrogant. It's hilarious. I'm sure he meant to do that I'm sure it was on purpose, right? But
You don't get eyes by being vanilla, you know?
yeah, that's for sure. Which is probably why I came off a little strong on that LinkedIn post, right? But yeah, so the arguments that he's making in this white paper, one, the big first one is longevity. So people are living longer. That's just kind of been the historical trend. And living longer and maybe not working quite as long means a long retirement that we have to fund, right? So
Yeah.
that a lot of times means we need to have higher returns in order to fund our retirement. So his point is crypto is where that return is going to come from. Whether or not that's going to be the case, I have not a whole lot of real strong faith in that. But looking at cryptocurrencies and kind of the lack of supply, I guess, and the increasing demand. And that's really all that drives prices in crypto, and that's one of the arguments against it too, right? It's kind of the greater fool theory. You're buying it to try to get someone else to buy it for more later. But the thing is, there is actually utility, and I think in the United States we kind of forget about that a lot, because payment is really easy in the United States and with US dollars, right?
Yeah.
But one of the other points that Rick makes in his white paper is that there are all sorts of people in the world who are unbanked, meaning they don't have access to a bank, and they live in maybe emerging market sort of situations where they don't have access to really strong financial guardrails.
Yes.
So cryptocurrency is one of the ways that they can actually have more access to the world of finance. So it's kind of in a way democratizing that for people across the world.
That's an interesting point. I think, you kind of hit the nail on the head when people talk about, okay, and I've always said, like, okay, my thing with crypto is, and I don't mean to always sound like a boomer, but no offense, boomers, but it's people say, well, it's a currency and it's an inflation hedge. I'm like, well, how are you a currency or are you an inflation hedge? Are you buying something so it'll appreciate, or is this something that you're going to use as money? And it was originally started more as a currency, which really has not seen widespread adoption. Right. But to your point, some of that has to have been the legislative, I'd say the political climate, trying to work out and figure out how do we feel about this. We definitely seen the pendulum swing on that here in recent years. But so you see more adoption potentially coming. But one of the things that was in the white paper that I found interesting was talking about the amount of dollars that are moving intra-country, with it from one country to another. And it's something like 12% of the global GDP, like trillions of dollars moving from one country to another as workers, maybe come to the US or they go to Europe or whatever, and they're working and sending money back and forth. And more like the blockchain application for, and for me, the simple way I think about blockchain is like if you had a public notebook that everybody can write in and nobody can alter, right? It makes it for very easy, seamless transfers back and forth, very quick transfers. So because we've wired money before, sometimes even wiring money where you have all the accounts and everything, it can take hours for a wire to show up and post. So
and it can be expensive.
As it does have blockchain technology has utility, and Bitcoin itself has built-in scarcity, meaning there will only be so much Bitcoin. So if there is widespread adoption or even just more adoption globally where more people are using Bitcoin as a way of transferring value back and forth in small quantities on their phones, then that alone could potentially lead to a boost in the price of what Bitcoin is at currently, is if I kind of understand the argument correctly.
Yeah, and I think part of it too is over time, volatility and returns should decrease, right? So I think it's like by the year 2140, all of the Bitcoins will have been mined, right? So we'll be at, I think it's like 21 million Bitcoins will have been mined. So there will be no more supply at that point. And already like 19.9 million have been mined. So we're pretty far into that. And as you have more and more people buying into it, you kind of have, at least theoretically, less. First of all, there are less potential buyers, right? As more and more people buy into it, you start with everybody, and then if 50% own it, now you only have 50% that could buy it, and there are only so many dollars, right? But as time goes on and more people own it, the volatility should dampen just because there are more buyers and sellers. It's a little bit more
it's a bigger pool, so it's a lot harder to make a big wave in a huge pool than it is
exactly.
In a small
one. Yeah, exactly. So the volatility should dampen over, the next 100 years. The returns should start to decrease. We're probably not going to see the massive returns that the first decade of Bitcoin had, right? That said, there's probably still a lot of room to run, and especially with the adoption of people like us, RIAs, maybe bigger players, adopting the ETFs and starting to add them to portfolios. Part of the reason I wanted to get into it kind of ahead of that wave, and one of the benefits of being a smaller RIA, is that we can move pretty quickly and start to add these things to our portfolios, where like it'll probably take 3 to 5 years for RIAs to actually get to the point of deciding how much they want to allocate to Bitcoin and Ethereum, and they're probably going to be using these ETFs to do that in large part. So I think there's kind of a big wave of demand there potentially coming, and then as that happens and volatility starts to dampen, there will be a better use case for it because of the lack of volatility.
Yes.
Yeah. You made a point on it being an inflation hedge too. And I think there's a little bit of, a lot of times we talk about inflation hedges, and our thought process is when inflation is high, this asset should go up, right? In order for it to hedge against inflation. I kind of disagree with that idea, right? Like stocks are a great inflation hedge. 2022, inflation was really high. Stocks went down a lot because interest rates went up, right? But over the long run, stocks have been a great inflation hedge because companies' prices are rising and profits are going up, and that's how stocks are priced, right? It's a little bit different with something that's like a currency or like a commodity, because they have their own value that isn't necessarily determined by the dollar, right? So in a year like this year with Bitcoin and Ethereum and really any other currency or cryptocurrency, the dollar has gone down quite a bit, which means that if you are a dollar investor and you're investing in anything that isn't dollars, your investment has gone up strictly because the dollar has fallen. So your investment may or may not actually be worth more to the world, but it buys you more dollars at the end of the day. So that's kind of another piece of it that I think is interesting.
That is an interesting point too. And you think about like, okay, over time, stocks have been a great inflation hedge, or that they have grown relative to dollars over time. But I think too, when you just think about, okay, like and I'm thinking of like much simpler terms than what you just described, but like on a year by year basis, that's not always the case. And, I think too, one thing that I found interesting about this white paper, and I've talked with our mutual friend Rick Lucchini before about, is, you look at a lot of the historical studies for safe withdrawal rates. And, I got to have Bill Bangin on and talk about that on my show a few months ago. But all these studies are based off of historical asset class performance. Like, how did stocks and bonds perform? Well, they're, in the 1970s and 80s, which is a lot of times where these studies are looking at, where high inflation and high interest rates are happening in a high tax environment. Well, bonds are making 8.5% interest, and you can't get that nowadays, even in a higher quote unquote higher interest rate environment.
Right.
It's higher than it was 15 years ago, but it's not actually that high compared to what it has been historically. So you've got a lot of bond ETFs. People are not buying individual bonds where they're getting their par value back. You're buying funds or mutual funds or ETFs, pools that own these bonds. So when the Federal Reserve changes rates up or down, all of a sudden your, negative correlation to stocks can be kind of gone. It's like, well, and at least that's how it's been since I've been in the business. You've hardly ever had times where stocks went down and bonds went up, only a couple of times. So does that mean that 60-40 is dead? I mean, probably, maybe not, but it means maybe things are a little bit different now than they were when a lot of these studies, were groundbreaking at the time. And maybe we need to be a little more nimble and a little more open-minded in how we're allocating client monies for, tomorrow, not just for yesterday. Right.
Yeah, absolutely. And I think that part of the issue there too is kind of in the math of diversification, right? So, in theory, holding bonds, if they don't correlate when stocks go down, if they don't both go down at the same time, you can get bonds going up when stocks go down, and that can kind of balance things out. But a lot of times we're holding, or, people building portfolios are holding bonds that are more meant to dampen the volatility of the portfolio than they are meant to diversify. So they're not really long-term enough bonds, and they're not volatile enough to really offset the downside of stocks or the upside of stocks, when bonds go down. And that, again, is a spot where an asset like crypto could help. Now, Bitcoin has historically been pretty correlated with the US stock market, so it hasn't really helped a lot from that perspective. But just the fact that it is so volatile can help a portfolio be more efficient, because there is still, even though they are fairly correlated, there is still a lack of correlation there, so that when one zigs, the other might zag, and you may benefit from that because you're going to rebalance, sell what went up, buy what went down, and then hopefully it goes back the other direction and you're able to do it again, right? And assets with really high volatility are better for that type of a portfolio.
Yeah, and that's the thing. Like even talking to Bill Bang, and he, his first study versus his second on safe withdrawals, he was like, well, first study we looked at 2 asset classes. By the second time around we did it, we added small caps and international, and we added, essentially he added more volatile asset classes, and that had a positive effect that across the board increased the safest amount that retirees could withdraw from their money by going up on the risk scale and not down on the risk scale. And I know you and I both look at statements from investors on a daily and weekly basis, and a lot of times it's like looking at a plate where you're like, okay, you've got all these different names and things on here, so you feel like you are quote unquote diversified, but it's essentially like a plate where you've got, okay, I have chicken and I have brisket and I have ribs. Well, guess what? Like that's three things. That's 3 protein things. You don't have any vegetables. You don't have any carbs or anything. You just have a lot of meat. You have lots of meat with different names, and that's not as much as I would love to eat that. That's not a very well balanced diet, right?
Right.
So we need things that zig when other things zag. And Rick Edelman thinks that crypto is the thing for that. I'm not sure about it. I mean, I just keep going back to the only thing that gives it value is that more people throw dollars at it. And the other thing I think about is like, if it is such a store of value or a currency in and of itself, why do we keep referring to it and how many dollars it's worth? Because that's what we're doing.
Yep.
We're selling it and we're using the dollars. So I'm not like I won't say I'm quite in the hater camp anymore, but I still have some big questions that I'm grappling with myself on how to feel good about if I were to introduce this. I don't know. Does that make sense? How do you feel about those
absolutely.
statements?
Yeah. Well, the largest source of value is how much someone else is going to pay for it later, That's not the only sorts of value. You know, we talked about
That's true. There's there is potential utility,
right?
And the technology there's value in.
Exactly. The thing is, a lot of the value is in stable coins for that type of value, and they may or may not need Bitcoin specifically. You know, it might be built on another system. So yeah, there are a lot of potential downsides to it, right? And there's a lot of risk to it. That said, you know, if we're talking about allocating a relatively small portion of a portfolio to it, I'm okay with taking that risk. You know, I'm okay with taking, you know, 5% of my Roth IRA and saying, you know, this could go to zero, but it could triple in the next 5 years. You know, like that's
right.
I'm okay with that. Personally, I'm okay with that, you know, trade-off.
Most investors aren't going to miss. I mean, if for a 5% for a 5% position, that would have to go to zero for you to be down 5%.
Right.
That would be pretty hard to imagine somebody who couldn't stomach that deserves to be investing in anything.
Right. Yeah. Versus, you know, if it were to triple, then you've added 10% to your return over that time frame, right? So, did I do my math right there? I don't know.
Yeah. We're gonna say yes. We're gonna say yes. Listeners, skip that part if the math is wrong.
Yeah.
But anyway, all right. So here's something that this might be interesting for some of our listeners, but you've talked about using this in Roth IRAs right now as kind of where you're doing that. Can you kind of explain to our listeners what your thought process is behind that?
Yeah, the main reason I've been using it in a Roth IRA is the tax side of things, right? The idea of an asset like this is, given the volatility, you're going to be doing more rebalancing than you usually would, and hopefully it's going to go up a lot. So whether it's a Roth or a traditional IRA, I think it belongs in a tax advantaged account. I like the Roth just because any growth is going to be tax free, right? You know, doing it in a traditional IRA is going to protect you from the year by year rebalancing tax drag. But if it goes up a bunch, you'll be a lot happier that it's in a Roth IRA. So
that's a great point. So being smart about where your asset location and not just your asset allocation.
Yeah.
As an investor makes a big difference. I mean, one thing that I definitely agree with Rick on in this white paper, and I'm sure you do too, I'd like to hear your thoughts, but I think investors by and large absolutely need to be taking a lot more risk. And you know, this always kills me. I've had some clients that were even like 30-something-year-olds, and it's like, well, this president or that president, so we want to get more low risk. And I'm like, stop. Like, if you are in, I get where you're coming from. I understand that feeling. But if you have a 30, 40, or 50-year time horizon, then the last thing you need to be doing is playing jump in and jump out with your investments. You need to just throw money at them or leave them alone. But what a lot of people don't realize is, like, for somebody who's retiring in their 50s, let's say somebody is going to retire in their 50s in 2030, 2035. That's 10 years of AI advancements in the medical field. Think about how quickly things like ChatGPT have taken off and grown.
Yeah.
Imagine applying that computing power to other aspects of healthcare. You know, I was reading in that white paper, when they first mapped the human genome, it took like an astronomical amount of money. And for them to do that now would be like a few $100s. So you talk about having a lot of advancements in healthcare, meaning even somebody who retires at 50 and 10 years from now, they're probably going to live a lot longer than somebody who retired at 50 years old 20 years ago. And that means that some of their dollars are going to need to grow for a very long time before they're ever touched, which means that they're going to have to take on a lot more risk, and they're in order to get the returns that they need to not outlive their money. So, I mean, I think that's the one thing that is a strong takeaway, whether you're pro or anti-crypto, is people probably need to take a lot more risk right now than they are.
Yeah. And some of that some of that risk being actual risk and not just volatility risk, I think is a good thing too, right? I mean, we talk about risk, we typically mean stocks go up and down a lot, right? But it's okay to take risk in an asset that maybe you don't know where it's going. It's just, it has the potential to go up a lot, right? And maybe it's a part of a an alternative sleeve. There are all sorts of different ways that you can look at adding this to a portfolio. But yeah, I agree with you. I mean, don't get me wrong, sometimes I look at the world and I think, man, we're in a really bad spot right now. Everybody has those feelings, right? But you can't let it impact your portfolio. You got to just trust that that things are going to come back around. If anything, it's an argument for more diversification. Taking single country risk. I see a lot of portfolios where it's all US.
Yeah.
I'm encouraging a lot of people to add some international exposure, just because you don't know, you don't know what the future holds for any given country. So you might as well be well diversified.
International did, pretty well in the beginning quarter, first half of the year. It was, as you're selling what's overweighted to send clients cash for distributions, I was like, hey, bonds are doing okay, and look at my international fund. It's actually feeding some people today.
Yeah.
That's huge. Here's a question. I know we probably need to come up. We're coming up on time, but for people who are like looking at getting into, there are so many different crypto coins, and if this is beyond the scale of what we can answer in a few minutes, then that's fine. But what process do you think people need to what are some key things they need to evaluate to weed out between maybe the crypto, the more reputable cryptos, or ones that have a better infrastructure and possible utility, versus the ones that are like, this is probably just a scam that somebody is launching to make themselves wealthy overnight?
Yeah.
I've seen a couple
People
of those
do
this year,
that?
in my opinion, but I'll leave it at that.
Yeah. I just keep it super simple. I just use what we can buy in a spot ETF. So I use Bitcoin and Ethereum. I think there's a strong argument for Solana out there. I won't pretend that I understand all of the technology behind the scenes and all of what makes one better than another. But really, is there, I don't know, when you start to get down to the lower end of it, or when people are launching their own personal coins, you start to run a much higher risk of it being a scam, and you might as well just stay out of it. I think it gets to be more like gambling at that range, versus buying something that is a lot more widely accepted.
So don't be looking for $ Preece to be hitting the market anytime soon.
Oh, I forgot to tell you, I actually launched it yesterday.
That's right. Yeah.
Oh,
wait till you can get a spot ETF for it.
Right. Oh God. Yeah. So, that's kind of my thoughts on it. And I think another thing that's really important to just to make a note of is that there are a lot of scams in just like Bitcoin trading strategies. You might see the name of someone send you a WhatsApp message or a Facebook Messenger message saying, hey, I've made a ton of money using this strategy. You should come and join me. Send this much money here. Just don't do that. That's another reason I stick to the ETFs, because you can just go on your boring old, whether it's Schwab or Robinhood or Fidelity, whatever, just go and buy the ETF just like any other ETF and not have to worry about it.
I like it. That's great. Well, whether or not crypto should be in your portfolio is probably something that you as a listener should decide after you have a serious consultation with your financial, tax, and legal professionals. But in the meantime, I think this has been a tremendous conversation. And I don't know, I like to learn different points of view. So I appreciate you being so willing to share a perspective that I was probably really, completely closed off to hearing 5 years ago. And
I was too
intellectually curious since then. So this has been a great talk, man.
Yeah. Thanks for having me on, Hamilton.
This show reflects the personal opinions and viewpoints of the host and Brandenburg Financial Services. Opinions and viewpoints are subject to change at any time without notice. No representation is made to the accuracy, completeness, or relevance of the information presented. The information discussed is general in nature and does not constitute investment, tax, or legal advice. Consult with your tax, legal, and financial professionals about your specific situation. Past performance does not indicate future returns, and any indices mentioned are for reference and cannot be invested in directly. Brandenburg Financial Services is a DBA of CS Planning, an SEC registered investment advisor.